Hey, Puppy Trades. I wanted to do a video analysis update of my plan for a stock market crash. Now, I know in my last video I said I was going to ask you guys a special question, put your feet to the fire in my little opening monologue of my monthly videos. I think you guys are going to get off easy this month. I think you're going to get off easy this month. We've had a few interesting developments in not only the stock market but Finchwood itself, and I think that there's more important than me asking you guys a question is really answering a question that, hey, this is real. This is I've invested probably, oh god, tens of thousands of dollars into a system over the past year that I've been studying for 2 years called the net credit choker. Now, the net credit choker is a very simple concept of getting as much income and dividends from a large basket of low beta holdings and using a smaller basket of long gamma positions, which consists of straddles and strangles on high beta stocks and ETFs to kind of hedge the yield that's coming from the dividend farm. So that's kind of the basic idea. I'm going to get a lot more into the nitty gritty details of what that's actually looking like in 2023. I'm very excited for tax season. Because the biggest risk with these covered call ETFs and with getting all this premium is paying taxes. So I live in a pretty low tax state. I'm not the highest income bracket, so I shouldn't be too bad there. And if things go the way I expect, life's gonna be pretty good. But unfortunately, life isn't good for one of my close friends, and I think this is really why you guys are gonna get off the hook. Because I'm in the Christmas spirit. All right, I know it's all astro theology, right? I know the 22nd of December was the winter solstice, right? And so the 25th is when the sun's going to start to come out and the days are going to get longer and longer until we have the spring equinox, which of course is when Easter is celebrated, and then that's when the sun's fully going to conquer the darkness. The days are going to be longer than the nights, and so on, and these are the beautiful cycles that we have. And even though I know it's all, I don't want to say BS, but desecrated by modern religions that know this is astrotheology. They know these religious texts are really about our planetary cycles. It doesn't matter to them, right? Because they get to manipulate us by telling us these stories, these fables. And they've been telling us fables for a long time. They told a lot of people a fable about what happened to this stock down here. PFE, 0% implied volatility, ranking percentile, top 200 volume and open interest, with some other stocks that made very notable moves. This picture was taken on March 21st of 2021. I participated in this Pfizer trade and bought an awful lot of options. I'm very happy about on Pfizer on that time, but no one really, the people who were coerced, some would say, manipulated, and in some parts of the world literally threatened into taking this medicine. They haven't heard about this. They don't know what long gamma positions are. They don't know that it was pretty clear the institutions were loading up straddles on Pfizer before a lot of interesting announcements were made. And of course, being long Pfizer in 2021 doesn't make anyone a genius, but it had an interesting connection to what happened in the oil market around early November. We started getting some of these, a lot more hardball stances from American politicians saying, hey, you gotta take this, or your employer is going to be fined. I think it was something ridiculous like $13,000 every time, or every time that there's a violation. And of course, a violation was just being, unmedicated, right? And if you didn't have your most recent medication, well, then you were as unmedicated as the rest, apparently. So a lot of people are being threatened and manipulated in early November, and that's when they like to strike, when people are being threatened, when people are manipulated, when people are scared. In November 15th, we caught the institutions buying tons of straddles on the oil sector. And so then there was this scary announcement, right? This news announcement on Thanksgiving night of 2021 that there's a new variant. So all the oil stocks very conveniently had a very sharp correction right after this. That allowed the financial institutions who got very lucky. They bought lots of straddles before a big announcement was made. So they got to buy all the oil stocks and collect these dividends risk-free. And of course, we know how that played out for them. And of course, they continued to do this throughout. Oh, this picture is actually more recent. I wasn't even really meaning to show this one, but they continue to do this throughout December. This picture is in mid-December, where they start loading up XLE, they start loading up Oxy, and of course, I don't get all of them right, but I did slaughter XLE, Oxy, and Pfizer primarily based on what I was seeing here. Participated specifically in Pfizer and a few of those energy names. Now, if you think that this is all just hogwash, rambling, whatever, then I want to show you, this is the picture from today. I took this picture this morning. We see Devon Energy is on it. We see Oxy is on it. I mean, if you think they're not going to do this again, I'm not saying that this means Oxy and Devon Energy are going to explode to the upside. To be honest, that's my bias. That's my bias, that they've been kind of consolidating for the next leg higher. That is what I think. But that's not what this picture is guaranteeing. What this picture is basically guaranteeing, there's going to be a massive move in Oxy and Devon, and we're going to be told a reason for it. And there's almost 100% chance the reason is not going to be there was high volume and open interest, while Oxy and Devon had 2% implied volatility rank. There's a 0% chance we're going to be told that. We were told for the exact same dynamics a year ago that it was because of a war and because of all these scary reports no one could have seen coming or whatever, right? But if you think that this just happened with oil once, this just happened with Pfizer once, this is going to happen again. It's happening right now, right? There's going to be a big move in the commodities market, in whatever market, right? And they're going to tell us some BS, right? What if Devon and Oxy explode and it's because Poland's invaded, right? What if Devon and Oxy explode because Vladimir Putin invades another country in Europe or something, and we're having the exact same conversation again, where all the sheep are talking about some BS news story, and I got a YouTube channel with 5,000 subscribers saying, nah, this is what happened. Like, we're not idiots. We can see what they're doing. They did this exact same thing a year ago. Then I said that's exactly what they're going to do to XLE and Oxy. And that's exactly what they're going to do to Pfizer. But that's okay. I'm not here to talk about that type of stuff today, because it's Christmas, man. It's Christmas. And even though I know it's all paganism, I think, astrotheology is beautiful. But even though I know it's all paganism, I can't help it. I can't help but feel the Christmassy spirit. I think that's because I was introduced to, I think, a new friend of mine named Grug. And Grug, man, he's pretty relatable. Grug's pretty relatable. So I'm going to try to help out Grug in this video. Grug says, B.I. Grug, go to Stone Market. Invest in Rockcoin. Rockcoin no go up. It's already sounding familiar. Sell Rockcoin. Okay, I wouldn't do that. I wouldn't have sold Rockcoin. Because 5 winners later, Rockcoin go up, right? Rockcoin up. And he lost his stones. Oh, man. This is pretty bad. He went to the stone market. He invested in Rockcoin, and Rockcoin no go up. So he sold Rockcoin, right? He made that rookie mistake. And then 5 winners later, Rockcoin did go up. So it took a little bit. It took five winners. I mean, that's 5 years, right? It wasn't an easy hold. I mean, Shaq had to hold Google for 2 years to make a profit, but he lost his stones, right? Now, Lady Bunga, not Unga, with Grunga. Oh man, Grug, I feel you. I've been there. I've been there. I didn't get much Unga with Grunga when I bought Litecoin at 229. I haven't gotten a lot of Unga from Grunga. Then what do? Oh man, what do you do? What do you do when you go to the stone market? You buy rock coin, it doesn't go up, so you sell it, and then 5 winners later it does grow up. You lost your stones, and Lady Bunga not want to Unga with Grunga. That's a tough predicament. It's a very tough predicament. So I'm gonna try in this video to really kind of show my solution to a predicament like that. A very familiar predicament like that, I should say. So let's just talk about what the Bears think. I don't, some people, oh, not all the Bears think this. This is what the Bears think, fam. This is what the real Bears think. You've all seen the megaphone pattern. And in all reality, I mean, at the very minimum, the Bears are just going to call for another marginal new low, just call for the crash at that point, baby. I got too much dopamine dependency. Anyway, SPY. The Bears say this is 1, 2, 3, 4, 5 waves up. 1, 2, 3, 4, 5 waves up. And an Elliott wave, that means we're going to end the big wave 1 and crash for wave 2. And this is the bear argument. And to be honest, if I'm only looking at the S&P, if I lived in a cave with Grug and I couldn't look at anything but the S&P, hard to laugh at this, right? Hard to laugh at this. So we're going to talk about what my plan would be if SPY goes to 2,000. We're just going to hash that out. I'm going to try not to tell jokes. So let's start. My top 3 holdings right now, hope you guys can see this, are JEPI, RYLD. So those are the top 2 by far, JEPI and RYLD. I got a basket of XYLD, QYLD, QYLG, and XYLG. Those are all covered call ETFs, buy right ETFs, half right ETFs. That are getting some very juicy premium from the stone market right now. I think the average beta of those particular covered call ETFs is about 0.80. So there's a really important caveat, obviously, that everyone's going to, if they're smart, and also annoying, going to mention right off the bat, is that covered call ETFs aren't exposed to the upside. So the idea with covered call ETFs, buy right and half rights, is that there's not much upside exposure. And so if someone just invests in covered call ETFs, the general idea is that that's not a good idea because there's not going to be any upside exposure. So that's, going to be the flaw in that strategy. We'll talk about where I'm getting upside exposure as well. Notable dividend holdings. I just listed a few: U.S. Bank, Camping World, Simon Property, Mid-America Apartments, Starbucks, Verizon, and real estate mortgage ETF, Morts. So the metaverse, so those those stocks and ETFs are just a sample of my dividend growth portfolio. They're still part of the same kind of dividend farm that I would say JEPI and RYLD, XYLD, QYLG, and such are a part of, but they aren't covered call ETFs. They're paying dividends based on their economic activity, right? Based on their income and revenues and stuff like that. So it's a little less reliable than a dividend from a covered call ETF. But at the same time, these stocks aren't covered, right? So they do have upside. Starbucks and Simon Property and Mid-America Apartments and Camping World and Verizon could appreciate very substantially. So I want to talk about my plan for a stock market crash. All right, so SPY would be going to 2,000. Okay, so SPY would be going to 2,000. So I'm going to pull out my phone calculator right now. Keep in mind the Metaverse ETF has a beta of 1.30. Bets has a beta of 1.38. I'm going to try to calculate what my exposure kind of would be in some of these scenarios. So I think SPY is at 384 right now. If it fell to 200, that would be a very big loss. Wait, 200 divided by 38, or 384, sorry, would be almost a 52% loss, nearly a 50% loss. I think 48% loss actually, if SPY fell, SPY fell to 2,000. I mean, we're talking about the S&P losing half of its value. So if the S&P lost 48% of its value, the Metaverse ETF with a beta of 1.3 would likely lose 62% of its value. And if the Metaverse ETF is trading at 7.13 now, and it lost 62% of its value, that means it'd be at 0.38 of what it is currently. That means the Metaverse ETF would be below 3. There's probably be a reverse stock split if that happened. But anyway, I'm just trying to put this bear scenario into its practical implications. So I have the 9 puts and I have 2 9 puts on the Metaverse ETF. One is from a straddle that I bought that expires in February. The other is from a long guts position that I bought recently. And so that is how I got the put that expires in in August, the 9 put that expires in August. I bought, you see right here, this long guts position. I bought the 9 put and the 8 call that expires in August 18th of 2023 for $265. I also have the 9 strike straddle for February that I bought. So we're just going to look at the Greeks on some of those ETFs right now. So we look at the Metaverse ETF. Interesting Greeks here. The 9 put for February has a delta of 86. So the delta is 86. That means for me to get my Delta dollars exposure, I'm going to multiply 86 times 7.13. So 86 times 7.13 gives me a number of 613. Now, that means that if I wanted to offset the bearishness of that big put that I have right now from buying the 9 strike straddle, I'd have to invest $613 in the Metaverse ETF. Now, this is kind of the important part, is that the Metaverse ETF is a hedge primarily. It's primarily a hedge for all of the long stock holdings I have. Particularly, it's a hedge for these long stock holdings that are selling options: JEPI, RYLD, XYLD, QYLD, and others. And they only have a beta of 1.80. Or sorry, they only have a beta of 0.80. The Metaverse ETF has a beta of 1.30. So while I would need to invest $613 into the Metaverse ETF to fully offset the bearishness of just this one put, in reality, I'm using this to hedge a basket of stocks that has a beta that's 50 points higher that's 50 points lower than the Metaverse ETF. So the Metaverse ETF has a beta of 1.30. It's hedging a basket of stocks that has a beta of 1.80. So if I multiply sorry, I just lost my numbers for a little bit. If I take 7.13 and I multiply it by 86, I get 613. Now I'm going to multiply that value by 1.5. And that's going to get my beta adjusted kind of exposure that I have right now to the downside, because I'm not buying the Metaverse ETF. I'm buying JEPI, RYLD, QYLD, and also, more low beta holdings like Verizon, like Mid-America Apartments, like US Bank, not necessarily low beta, but Camping World and Starbucks. That's a little, less growthy, a little less techy, I guess, than the Metaverse ETF. So I take 1.5 and I multiply it by 613, I get 919. So just for this one put, because the Metaverse ETF has a very high beta, and because I'm using it to hedge a basket of stocks that has a very low beta, I would need to invest $919 to offset the bearishness of this Metaverse ETF put if I'm trying to do it by buying the lower beta holdings that I've given an example of up here. So that's the general idea. If we look at this guts position right now, the 9 put and the 8 call that expires for August, we can see maybe why I bought this position. So the guts consists of the 8 call for August and the 9 put for August, and I bought it. I bought it when, the Metaverse ETF was around 7.20. So the intrinsic value of an option is very easy to find. You take the strike price of the option and you subtract it from the current price of the underlying holding. So at the time that I bought this put for August, I think I bought it for about $200. I bought the call and the put, the 8 call and the 9 put, for $265 total. But at the time I bought this put, the Metaverse ETF was at about 7.20. So if I paid $200 for the put and the Metaverse ETF was at 1.80, or was at 7.80, so it was at 7.20 when I bought it, then it was $1.20 in the money. The put, sorry, I've almost messed those numbers up too many times. I bought the 9 put on the Metaverse ETF and the 8 call on the Metaverse ETF that expires August 18th, 2023. When I bought that position, the Metaverse ETF was around 7.20. So if I take 9 and I subtract it by 7.20, I get that the put option that I bought had an intrinsic value of about $180. So most of that put was intrinsic value when I bought it. And if we look at the guts position as a whole, I paid $265 for it, but I'm only really risking $165 because there's $100 of intrinsic value between the 8 call and the 9 put. So that's just a general, the deeper in the money an option is, the less theta decay it's going to have, all else being equal, because the further in the money an option is, the more it's akin to just actually owning the stock, to the point where once an option hits a delta of 100 or a delta of negative 100, it is called stock replacement. If someone has a call that has a delta of 100, it is basically the exact same thing as owning 100 shares of that stock, unless that stock pays a dividend, obviously. And if someone has a put that has a delta of negative 100, it's basically the exact same thing as being short 100 shares of that stock. So the deeper in the money an option is, the less time decay, the less time value it's going to be made up of, and the more intrinsic value it's going to be made up of. So we look at the 9 put for August right now. It has a delta of 68. So I'm going to take 68. I'm going to multiply it by 7.13 times 7.13. And we get $484. Now, if I multiply that by 1.5, because it's hedging a basket of stocks and ETFs that has a beta of 0.80, and the Metaverse ETF has a beta of 1.30, I'm going to multiply it by 1.5, and I get 727. So just with the 9 put for August, and just with the 9 put for February, I have 2 option positions where, based on the betas of what I'm actually investing in that I'm using it to hedge, I am almost going to need to invest $1,600, $1,700 just to offset the bearishness of just those 2 options. Okay, we're still on the Metaverse ETF, and I'm not even really going to get into the fact that I own the 8 strike straddle for February. I own the 7 strike straddle for May, just for the Metaverse ETF, just for the 9 put for February, just for the 9 put for August, if I'm adjusting the Delta Dollars exposure that I have to the downside for the higher beta of the Metaverse ETF, just those two options, I would need to invest $1,600 to $1,700 in this kind of basket up here that I've outlined: JEPI, RYLD, XYLD, and of course, I'm going to have to get my upside exposure through other avenues. So I have to get my upside exposure through other avenues. The call portion, remember, because these are straddles in guts, there are call legs to this. So that's going to answer the question of, well, what happens to you if the market runs off to the upside? All these calls are just going to explode. So that's the beauty of a straddle. You're not just getting the downside exposure, you're getting the upside exposure as well, and you're getting unlimited exposure. It's not a credit spread where the exposure stops. The exposure doesn't stop with a straddle to the upside or the downside. Let's look at AGNC. A little bit of an extensive history here. The reason I want to go over AGNC is because it's such a great hedge, in my opinion, or the straddles on AGNC are such a great hedge for financials and real estate holdings. I think AGNC, I can check right now. I think AGNC has a beta. I think AGNC has a beta of 1.1 something. This is what I think AGNC is doing. It's an ABC correction. But all that really matters is that from the 2020 low, we form a wave 1 and a wave 2. So potentially a very big wave 3 opportunity towards 20 for AGNC above an invalidation level of 6.25 that is getting a little wide. So the bears are going to say this won't happen, and the AGNC is going to, go break below 6.25 and go lower than that even. But if we look at AGNC, we can go to the price overview and we can see some interesting things. AGNC has a beta of 1.20, so it's actually more volatile than the S&P. I think that's why I think it's such a great hedge or the straddles that I have on AGNC are such a great hedge for financials and real estate holdings, because AGNC does have a little bit of a high beta and it's super highly correlated with the real estate sector. It's a top holding of Mortz, and it's just, especially with the way that interest rates have been, all these interest rate announcements have been causing, quote unquote, these moves in the market. I think AGNC long gamma positions have been very useful for me, especially because a lot of the financials, a lot of the real estate stocks pay a lot of dividends. And that's the next phase of the study that I'm going to be doing, is almost primarily focused on how these options, these married puts, these straddles are being used to capture dividends in stocks that are risk-free. That's what I'm going to spend the next few years doing. If we look at AGNC, I bought the 12 strike straddle for March a long time ago in September. That very quickly ended up being 100% gain. It took a few steps. So I think a few weeks after I bought the 12 strike straddle for March, I think I bought this in September, AGNC fell. Through the process of it falling, I shifted down to the 11 strike straddle, then to the 9 strike straddle. Those moves locked in a 57% return, then a 19% return. And then eventually I exited one of the positions. When I went to the 9 strike straddle, I was actually able to double the amount of contracts I had. So then I exited half of those for a 27% gain. And so I made over 100% return on a directionless trade on AGNC. And in this system that I'm building, that's all pro bono. That's not even any profit that I get from a straddle isn't even really calculated into the math of the success of the system that I'm doing, because I'm only really looking at these straddles for the downside exposure. Any profit that I get, that's just the bonus. The idea is that these are all insurance. These could all go to zero, and I'm collecting enough premium from RYLD and JEPI and XYLD and the covered call ETFs and the real estate stocks that it would still make up for these positions hitting max decay. So I made 100% return on AGNC. Right now, there were a few developments with AGNC. It was so much what I was doing was for exposure that I didn't quite treat this the way I would have if I was trying to make, straight profit on the straddle. I had I ended up buying the June straddle for $223 just so I had it. And then once I was able to buy the 10 strike straddle for for January 19th of 2024, I bought the 10 strike straddle twice. Once I bought it for $311. I sold it for $356. That was a 14% gain. But then I bought it again for $305 recently. Once I bought that 2024 straddle, I didn't really care to have the June straddle anymore, so I sold it for a 7% loss. I bought the June straddle, the 10 strike, for $223. I sold it for $208. That was a 7% loss. But I sold that to buy the guts position on the Metaverse ETF, which was so important for my exposure. And the reason was because once I had the 2024 straddle on AGNC, I was kind of good. That's kind of what I was looking to get. AT&T, a little interesting history here. Not actually too much depth to the history on AT&T. I bought the 15 strike straddle in early October. I sold that for a 15% gain. And I bought the 17 strike straddle. I sold that for a 14% gain. And I bought the 19 strike straddle, which I'm still in, for an average price of $306. As AT&T has fallen, or the few times AT&T has fallen from 19, I've bought shares of Verizon, kind of as a pair trade. I've sort of loosely explained what a pair trade is. I'm not necessarily betting that Verizon's going to outperform AT&T. AT&T could outperform Verizon, and I'd be fine. But I'm generally expecting that Verizon's going to do better than AT&T. So the straddles on AT&T ideally are going to also hedge my Verizon position, but that's not something that I'm betting on. That's just something that's more in the back of my mind. My investment in Verizon and my investment in AT&T straddles, could be completely independent of each other. And so that's the idea. We look at ET right now. This is for my commodities exposure. My ET trade history is very long. It's got for at least 20-ish% adjustments that were positive. Right now, I am sitting on a little bit of a theta bag with ET. I bought the April straddle. I think it's the only April expiration they have. That April 20th-ish expiration. I have the 12 strike straddle on ET. I bought that for $272. I think I'm a little down on that. I have the strangle, the 12 strike call, the 10 strike put on ET for 2024. That's really just to give me some commodities exposure, some energy exposure. And it's really because I'm worried about ET going to the upside. But these are my downside exposure plays. The BETS ETF. I didn't do the BETS ETF for some reason. This one's actually really important. I've seen PIN and I've seen DraftKings on the straddle screener. I've seen Caesars Entertainment on the straddle screener. But really, BETS is a consumer cyclical, very growthy, very high risk, high reward ETF. But it only has a beta. It has a beta of 1.38. And so I actually do want to calculate the Delta Dollars exposure that I have right now. So currently, I have the 15 strike straddle on BETS, and we're going to calculate how much exposure that's giving me, because that's giving me a lot of exposure. And so this is a really important calculation. I was a little maybe word vomiting with how I was calculating the Delta Dollars for the Metaverse ETF. I'm going to try to be a little more clear with BETS. So I have the 15 strike straddle on BETS that expires 4/21/23. If I look at the 15 put right now, I'm going to click on it. It has a delta of negative 55. So I'm going to multiply 55 times 14.12. 55 times 14.12 gives me 776. Now, the same thing for BETS is that this is actually 60 beta points higher than what these straddles are being used to hedge. So the BETS ETF and the Metaverse ETF are being used to hedge these huge income positions that I have from JEPI and RYLD and XYLD that have a beta of about 1.80. Sorry, I keep saying 1. They have a beta of 0.80. They have a beta of 0.80. Bets has a beta of 1.38. So if I take 1.58, which is the difference in the betas, there's a 58 beta point difference. So I'm going to take 1.58 and I'm going to multiply it by 776. That's going to give me about $1,200. So if we're just looking at the Bets ETF and we're just looking at the Metaverse ETF, and if we're really just talking about 3 puts, the 9 put for February on METV, the 9 put for August on METV, and the 15 strike put for April on Bets, what we're looking at, if we're adjusting for the betas of what these ETFs are versus the betas of the underlying hedges, we get that I would need to invest about $2,800 into this basket up here to offset the bearishness of just those 3 puts. Just those 3 puts. And remember that as the Metaverse ETF falls more and more, as the Bets ETF falls more and more, the delta gets higher and higher. So my downside exposure is going to keep growing if the stock market crashes. And so that's really the whole point, is that if the stock market did crash, I'm trying to show by the time we're below this low, I have more downside delta dollars exposure than I could invest against to offset that bearishness.